before placing any trade. All securities and orders discussed are tracked and monitored in virtual trading accounts. Virtual account prices and returns may differ from actual trading results. Commission costs are excluded. Neither PhilStockWorld.com, PSW, nor its affiliates, nor any of their respective officers, personnel, representatives, agents, or independent contractors are in such capacities licensed financial advisors, registered investment advisors, or registered broker-dealers. Nothing contained in this webinar, website, or promotional material constitutes promotion, recommendation, solicitation, or offer of any particular investment, security, or transaction. Trading options involves risk. Visit the OCC website, www.optionsclearing.com, to read characteristics and risks of standardized options. PSW provides educational and training services that are meant to teach you the risks and potential rewards of trading options. And we are not a service that tells you what to trade. We are not implying or guaranteeing any profit. As always, do not trade with money that you can't afford to lose. Past performance does not equal future results, and the results discussed in this webinar are not typical and are only valid on that specific or identified date. Your results may vary. By accessing this webinar, you agree to hold the above harmless from any losses you may incur as a result of the information discussed in the media identified above. By accessing webinar, you agree to be placed on our mailing list and receive our newsletter. Rest assured we take your privacy very seriously, and we will not distribute or sell your information to anyone. Yay! Now we can get going. Oh, and what a day it's been already, right? Let's see. Let me share my screen, and we will all see what I see. So Al says, thanks from the unwashed side. That's great. Oh, that's private. Well, don't talk to me privately. Then I can't answer you. Anyway, where are we? Well, this screen is completely uninteresting. Let's go to a better screen. And, that's not a better screen. Well, okay, so basically, let's talk about what did we write today. Is this right? Oh, yeah, here we go. So this morning, we talked about $21.20 and bust again. Okay, that was what the topic of today was, and of course, that's exactly what we did today. All right. I love it because I love writing these headlines before things happen, and it like freaks people out, and they think that I'm like cheating with dates or something. But I just think the stuff's kind of obvious. I mean, you can see it coming from a mile away. So I try to, like, in the day's headline tell you what will happen, what will happen that day, not what did happen or what whatever else bullshit people write. I just say here, this is a theme for the day because this is what's most likely to happen. So yeah, we had the same. Yesterday we had this total bullshit move where the S&P through this gap. All right, so that was Friday's close. Then we gapped up Monday. No volume, of course, in the futures here. And then we flew up into the open. That gets all people excited and jump in. They think there's a rally going on. And then, all the selling. Don't forget, though, when you see up volume, this just means that the volume was high and the direction was up. The point is there's no volume here. Then you trick people into buying at the open. The programs that are selling, these programs that are dumping shares for the people who have a lot of stocks already, they're selling into everyone who's buying. Because for everybody who buys, there's somebody selling. That's always true. The question is whether there's more buyers than sellers. It kind of pushes the action one way or the other. So after creating this excitement on no volume at all, then they get some momentum that's good for another almost about the same distance that they got in the first place. But then this volume here, they run out of suckers kind of, and people are still coming in, but they have to sell more carefully, and the volume drops down. But if you add all these bars together on the way down, they equal a lot more than what it took on the way up. All right, and that's how net you have outflows of cash. So money is still leaving the market, and if money's leaving the market, it's making it weaker. There's less support. There's less money holding up these share prices. In other words, it's like, we use this used car lot example because, you have 100 cars that are $25,000, and you sell 5 of them for $30,000 and $35,000. You sell 3 for $30 and 2 for $35, and then you sell 1 for $40. Okay, you only sold 5 cars out of 100. So, but the market then tells you that the other 95 cars are all going to sell for 40, right? Because the last price that was paid was 40 on 1 car. It doesn't matter that it was 1 car, though. It matters that 40 was the last price. So now people who have the 95 cars, and it's not 95 cars, it's still 100 cars. And the guy who bought the first car at $30 is already up at $40. He's up 33%. Maybe he wants to sell his car now. So the supply hasn't necessarily diminished at all of cars. They're just priced much higher now. Meanwhile, though, in the reality of the world and the market, the supply of money hasn't increased enough to support the price of the shares. So more so, when you think about what's happening on this low volume rally, let's say there only was enough, let's say the shares were fairly priced at 25, right? You know, same car shares, whatever, but the point is, the shares are fairly priced at 25, right? Or let's say the cars are fairly priced at 25,000. It's easy to do with cars because you can actually think about how it works. You have 100 cars priced at 25,000. That means that you think your 100 customers can afford $2.5 million to spend on cars. You anticipate that the market is 100 customers and that your 100 cars will sell to 100 customers for $25,000 each. That's your initial pricing. All right? Now, on day 1 or 2, right away, there's a rush or somebody manipulates the price and they sell, like I said, there's a couple of cars sold for 30 and a couple of cars for 35 and 1 for 40, right? But the problem with that is now that you've repriced your 100 cars at 40,000, you've actually repriced from 2.5 million to buy 100 cars to 4 million to buy 100 cars. But what if there's no possible way the other 95 people can afford that? You've not only have you overpriced your cars for the market, but you've actually made it impossible for the average person in the next group of 95 to buy your car. Right? Because if you had a bunch of guys, let's say a bunch of factory workers who were going to, who your audience was in a closed system. You have 100 factory workers. They're all going to buy a car. You're the guy in charge of selling cars. You bought these cars. You were going to sell 100 cars for $25,000. You worked it out that that's what they could afford. So what happens? Now, because of the manipulation that took your first 5 cars to 40, now your entire fleet is priced higher than any one of the new people can afford. You understand that? Because the people physically can't afford a $40,000 car. And you guys, I mean, we've all been there at some point, right? Everybody went to college or something. Not all of us had like huge rich parents. You just can't afford it. It's not an option. I didn't, when I went to get my first car, not my first car. All right. When I went to get a car when I was in college, put it that way. My first car was actually a nice car because I got a good job out of college. When I went to get my first car, though, even so, I mean, I didn't go to the Mercedes dealership. I got a nice Mazda when I got my first car. But still, when I went, when I would get my first car in college, I had a $10,000 budget, okay? If you would have told me, oh, no, it went up to $15,000, I would have been like, I can't get a car. I got to make a new plan. I don't just suddenly say, oh, I guess it's going to be $15,000 instead. What the hell? It doesn't work like that. And it doesn't work like that when you tell people who can afford a $25,000 car they need a $40,000 car. They just don't buy it. And that's what low volume is telling you. People just aren't buying it. And what do we know also? We also know from other studies that we've looked at before that 6 out of 7 transactions are companies buying their own stock back. That's not even a real transaction. So 80% of the transactions you do see aren't even human beings buying anything. So the volume is at all-time lows. This is a almost illiquid market. And that should be terrifying to people who are trading, because if you do want to trade and you do want to sell, you get days like this where everything plunges. And that's why you're getting this kind of action. That's why you're coming up on no volume and then all day long it's selling, because the guys who run these computers that take you up on no volume are the same guys that run these computers that sell into every sucker that Jim Cramer can chase into the market all day long. And not just Jim Cramer, all these idiots on TV who tell everyone what a great deal the market still is and what they should still buy and so on and so forth. It's a very dangerous time to invest. And it doesn't mean they can't keep it up for a long time. It makes it a very dangerous market. And here we have it again. So today we had, here's 3 o'clock in the morning. Let's see if we can get a closer chart. Well, let's do a 5-minute chart. Let's see how that looks. Okay, so here you go, like 3 in the morning, 4 in the morning, they run it up, they keep running it up, there's no volume here, there's nothing going on, right into the open, 9 o'clock, big program starts, push, 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 right at the opening bell, they're punching the high, and then boom, then look at this volume. Now look at the serious volume here. I don't know if you guys can see it clearly on your screens, but here's the top volume here. Volume here, don't forget this is the last up chart, last up volume is right here, and then selling, 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 lots of selling, 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 more fake on low volume. Now your volume is down here and it starts going up and then selling, 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 selling. And look at this crap. This is a bullshit market. It's a market you should be really, 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 really concerned about having your money in. All right, and that's why we mostly don't. We're mostly in cash. We're not taking our gains seriously right now, except, you know, we just took oil off the table because it punched up. Oil's doing the same thing. Oil's, you know, rallying on. Here's oil, low volume, low volume, low volume, and up it goes. Then suddenly high volume, and you're flatlining. All right, now here I'm down $7,000 right now on oil. Because I kept pushing my bets. So far I'm wrong. If this thing goes over 61, I'm going to be crying. But that's where we are at the moment. All right, meanwhile, this guy's down. I made, what, 1,500 on the S&P. I bailed out a little bit early on that one. And we'll see on the rest. All right, so that's my story so far today. We'll look at all the indexes. By the way, questions are really welcome, you know. It's not like I have a huge thing plan. Here's the Nikkei continuing to fail, so that's one we are holding on to. We think that's going to a lot further to fall. And as you can see, it's just weak, 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 weak. All the indexes are weak. And that's with the dollar falling 1%, 96 to 95. The dollar fell 1%. In an attempt to support this. This is another way they manipulate the market, by pushing. It's easy to short-term manipulate the dollar, especially after the European markets close. So here's, because we're the only ones trading. Unlike Americans, Europeans actually just clock out and quit. They don't sit around all day. They don't trade after hours and things like that. They stop trading and they go home and have tea, or whatever, or see, you know, tea, whatever they're drinking in most of the country, most of Europe. So right about here, this is when Europe starts closing at 10:30, and then it closing by 11:30. Everyone's gone, and you see the dollar just dropping, 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 because there's no one trading against it. It's easy to knock it around. All right, so Mike's asking, do I think oil is going to 64? I do think oil is going to 64 in July. I don't think oil is going to 64 in May, and the reason for that is because I don't have the chart. I don't have it here. I guess I should probably figure out how to put that up over there. Well, it's not complicated. I just got to get the screen up. I'll tell you, though, there are 400,000 open June contracts on the NYMEX. That's essentially a request to deliver 400 million barrels for June. July's got 250, so that's 650 in just 2 months. Then August has 81,000. That's 757. So 650, 730, or yeah. 730, and then there's 150 in September, so that's 780, 880. There's almost 900 million open barrels on call for the front 4 months. That's a really, really big number of barrels on order. That means there's going to be a lot of pressure in the June contract as we move in towards May 20th. You guys can probably see my calendar if I pop it up. Oil contracts expire 3 business days before the 25th. So not a business day, not a business day, 1, 2, 3. So Wednesday the 20th is probably the day that these contracts expire. So we have 2 weeks of trading. There's this session plus 10 more. So 11 sessions to get rid of 400, because they don't want any of those barrels. They have to get rid of 400 million barrels and roll them into the other months in 10 sessions. That's 40 million barrels per session they've got to roll out. That's a lot of pressure for them to start selling. That's going to cause a compression and probably knock prices down. No matter where they are now and what they get them up to, there's still going to be a reckoning coming along. What the hell is that? It's the weirdest chart I ever saw. Oh, it's the old CL, that's why. I'm like, why is that chart like that? That makes more sense. All right. So, meanwhile, then there's the logic, of course, that the dollar isn't going to go below 95 because there's nothing fixed in Europe. They still got the Greece problem. Japan's still dumping their yen. Why would the dollar be weaker than those guys? Our Fed's going to tighten. They keep telling us that. Nobody believes it, but they are. So there's good reasons to say I still think oil will come down. Now so far I'm pretty wrong. So but on the other hand I was pretty right when I called the bottom at 45. I'm sorry. Let's be real about this. I called the bottom at 50, and when I went to 45, I pressed it really hard. That worked out fantastically, and now we're at 60. I'm calling the top at 60. It might go to 65 before I'm right. It's just a range I'm playing, so it could go outside the range. You got to be very, very careful in these things. But again, the reward is extreme. I mean, we made a fortune going from doing our oil bets when they were low, and I'm hoping to make some good money as they're high also. So, there's nothing definite about that though. It's not a safe play because over the long term, oil shouldn't have been this low. But I do think that when you start getting up to 65, 70, you're really hitting a top. China FXI, time to sell puts today. No, wow, really? On China, let's see. Where is my little charty thingy? Don't I have those up? I am so, oh, that's easy to fix. So I just got to grab one of these charts. Hang on, I got to find one. These are my favorite charts from FinViz. If I can find one. Not that one. That one with the lines. I think these are so convenient. So we have to open image in a new tab, and now we got them. Okay. So FXI, in fact, we were just talking about in chat earlier where I said now we got in at in the short-term portfolio. There it is. Look at that, 122%. That's pretty good. Here's our FXIs. We had 30 of them. We bought them for $1.58. They're now $1.73. So they really shot up from yesterday. I had a call. We had a note. I bet it's in the book here. Did I book it? No, I didn't book it. I know we made a note last time though that we said we wanted to double down at $1. It went down to $1.07, but it never hit $1. So unfortunately, we didn't double down, which kind of sucks. But anyway, so that's $1.58. These are the June 50 puts, and I'm not in a hurry to take them off because look at this. This is nothing. See this gap? This is the same kind of bullshit. Air gap up to here. There's no support whatsoever in this zone. You guys know about gap fills, right? So, and also there's your line. This is the 200 whatever. The 200-day moving average is way down here. Oh, I'm sorry. No, wait. That's the 50. The 200 is way down here. So the 200 days way the hell down here. The 50-day moving average is here. This is just a 20-day moving average, this purple line. That's pretty meaningless, and they already failed it. So I'm thinking timing-wise and everything else, we could really come down to 46, 47. And if we hit 47, we're good for $3. So we're good for 100% from here on what we've got. So no, I'm certainly not looking to sell puts. I don't want to be. You talk about selling puts, that puts me long on FXI. I don't want to be long on China. China's a disaster. China is a massively overheated, overspent economy that's going to grind down and stop. And it's not going to, it's not going to be disastrous from a Chinese point of view where it's like everything, they're not going negative, but going from 7% growth every year to 2 to 3% growth because you pretty much maxed out is really painful. Okay, it's really, really painful. It's like the pain we went through in the States after the war and after the huge growth we had after World War II. We had this sort of a lull, and that lull felt like a depression almost, but it wasn't. It was just a lull. It wasn't. We were still growing. We were still doing okay, but it didn't seem like we were doing okay because compared to where we were, it felt awful. And that's what China's going to be going through for the next probably for the next 5 years. And then who knows if they fix that or not. But meanwhile, their stocks are priced as if they're going to grow at 7% for the next 5 years. So that would be 35% bigger economy. They are not going to have a 35% bigger economy in the next 5 years. It's not going to happen. And anything lower than 35, so let's say instead of 35, they have a 20% bigger economy. That means their stocks are overpriced by 15% at least, even with, strong forward-looking whatevers. So you're definitely in a zone in China where 15 to 20% correction would be no surprise whatsoever. And meanwhile, what's a 20% correction from 52? It's 42. I'm not talking about a huge correction. We're just talking about this was silly. At least half of this was very silly. So I'm counting on this. I'm counting on half of this being silly. I'm not even saying all of it was silly. All right, so there's my FXI answer. Nikkei is great. That's another one we have. That's the one we have a much heavier bet on, EWJ. And why do we have a heavier bet on EWJ? Because Japan is spending, what's the number? I hate to say this number because I think it might be true. I think they're spending something like 40% of the tax revenues they collect, at least 30%, it might be 40% of the tax revenues that they collect go to pay the interest, just the interest on their debts. So in other words, for Japan to make their next interest payment, now we do 15% or 18%. So yeah, I think they're probably at 36. They're like at least twice as bad as us. For Japan, just to be current on their debt each month, it takes over a third of their collected taxes. So if their economy contracts and they collect less tax revenue, that's bad. And don't forget, a big portion of their tax revenue now is coming from sales tax because Abe cranked it up, like doubled their sales tax. It's almost like, I think it's like 10% now, it was 5%. So their sales tax is out of control. The people aren't purchasing, because everything's got a huge sales tax on it. The corporations are selling less internally, and that's okay as long as China's buying and Europe's buying and the U.S. is buying. But then what's wrong with that picture? What happens when China stops buying from them and Europe isn't, and Europe already is slowing down a lot? And what if we stop buying? What if our little rally that we're having here with the consumers taps out? They're going to be totally screwed. Not only that, but this this 1/3 of your collected revenues going towards paying the interest is based on paying interest of 0.1%. What if interest goes higher than 0.1%? At 0.2%, it will take them 60% of their tax revenues to pay their interest. And at 0.3%, it will take all of their tax revenues to pay off their interest. Is that realistic? Anyone ever heard of inflation? Does it ever happen in the history of mankind? If we have inflation, if inflation rates go up to 3%, 4%, 5%, Japan is bankrupt. There's no possible way they can pay off their debts. So yeah, I think Japan is a fantastic short. That's why we keep shorting it. It keeps going up and we keep shorting it. China keeps going up, we keep shorting it. Because this can't last. You're at the point where it's ridiculous. You're at the point now where people are in so much trouble with debt that the ECB and the Bank of Japan have to actually pay people to borrow money. They're paying, there's a negative rate of exchange. So the banks, the big banks who are borrowing are getting paid to borrow money. And if you're a consumer, you're paying to borrow money. You're paying, you're paying to lend money, just like a central bank is doing. You're paying, when you buy a note that's negative 10%, what are you doing? Negative 1%. When you have a negative 1% note, which surprisingly, there's trillions of dollars of them being sold already. People were so scared of losing their money that they're putting money at negative 1%. Trillions of dollars are going in to negative 1% loans. What does it mean, negative 1%? It means every year, however much you loan, they take 1% of it. So you have $100. If in year 1 you get back 99, year 2 98, year 3 97, year 4 96. That's how it works. And people are actually doing this. It's not no rate of return. They're actually taking your money as a favor for holding it for you. It's really bad, okay? And that's why it's crazy. I know it's crazy, but you gotta sometimes just not participate in these bullshit markets. And you gotta say, I'm not giving money to any government for negative percentages, and I'm not gonna stick it into the market on the hopes that this stuff keeps going, because something's gonna break. And when it breaks, your cash is gonna be worth a fortune. But we don't know where and we don't know when yet. So the best thing to do is what we're doing is we're lightly participating. We've got plays, but not a lot, because if everything falls apart, we'll still have our cash, and then we can make some really good plays. And those plays, by the way, you know this, because we just went through it 8 years ago. Sorry, it's like 7 years ago now. We just went through this 7 years ago, so I can't imagine there's anyone here who wasn't around in 2008, where you get bargains like you would not believe. And if you look at, here you go, Twitter, a popular enough company, right? Look at these bargains that you get in a choppy market. And Twitter's not the all-star company of all time, but, hey, I mean, this is a good price. They're as good as Facebook. They're as good as all these other social media companies. How can you? That's the funniest thing. I think the problem with Twitter is that the average adult isn't a big Twitter person, but the average kid is, and they're going to grow up to be the average adult, and they're not going to graduate to Facebook. We're old. We think Facebook is a real thing, but that's because we're old. We're old. We think LinkedIn is a real thing. Our kids look at Facebook and LinkedIn and think like, this is so slow and clunky, and how are you getting information out of this thing, and who the hell has to talk for this long to get their point across? Our kids communicate in little teeny tiny 140 characters. They're being trained that way. Twitter is a real platform. It's hard to monetize because it's so compressed. They are figuring it out. But, selling them short, and just because they're having a little bit of a growth pain, is silly. And it was proven silly here when they had they had their earnings here and disappointed. They went down to here. Now they're coming back. They're going to come back to around the 35 line probably, and then people will start buying them again. That's all. You just got to play the channel. This channel runs from 35 to 50. You get out when it's at 50. You get in when it's at 35. You're going to be a happy camper. All right, and our Twitter play at the moment, we took an aggressive one actually in the short-term portfolio. We took, and look, we're not knocking ourselves out here. We, what? Short-term portfolio, what did we do? What did we have? Oh, we have the puts, I'm sorry, no, that's right. We took the 38.45 of January, 38.45 bull call spread, and I'd say at the moment, it's still the same basic price we paid for it, so it's still a good play. The 38.45 bull call spread, and we sold the 35 puts And our net on this was net zero. We didn't pay anything for it. It was $7 minus, we actually got a credit, $1.10 credit. All right, so because that's 7 plus 110 is 810, less the 7 we paid. So we laid out 7, we got a $1.10 credit, we took 5 contracts. So we got a $550 credit, and if it all goes well, we're going to make 5 times the gap here of $7. So we make $3,500 plus the 510. So we'll turn $510 into $4,010 if Twitter gets back to 45 by January. And if it doesn't, we're going to roll and go to next year and take a better position. But I like that trade. That's a good trade. All right. Another one that also is huge sale. You know, this is what you want to do with your money. It's like, why should I deploy a lot of my money on IBM or Apple or whatever, or any overpriced stock right now, when I can take $500 and turn it into $4,000 in, 8 months? So what's where is the advantage in me buying Apple at 130 because I think it's going to go to 150? That's just a waste of money, right? That's a waste of my time. 130 to 150, I'm going to get excited about that when this thing is going to make me 7 times my investment. So I can make 700% on this, or I can make maybe 20, 30% on Apple, if all goes well. But meanwhile, I have to tie up a ton of money in Apple here. I got to put $500 down. It's a no-brainer. This is why this is why we're not deploying much of our cash. This is why in a $222,000 portfolio, we have $184,000 in cash. We're only using about $40,000. It doesn't take much money to make a huge amount of money, so why use it? And you don't want to be greedy, because if the whole thing blows up, we're only going to lose $40,000. But then we'll be able to buy everything on sale. So that's the position we want to stay in right now, just in case. So the long-term portfolio. And I'll talk about another huge sale that we're taking advantage of. See, the long-term portfolio is up 52%. That's pretty good, even on bad days today. For some reason, the mix not for some reason, the mix in the long-term portfolio is a lot of energy stocks and a lot of material stocks. So it holds up very well. So it holds up very well on days like today. So even though the rest of the market's selling off, our long-term positions are not the kind of positions that everybody else is in. That's why we're doing well. We didn't fall for the bullshit. We didn't chase all the high numbered ones. We went after the low-hanging fruit. We went after the stuff that was on sale. So we don't get damaged by these little sell-offs. So the other one I was going to talk about, we got lumber liquidators. So this is 60% off as far as if I calculate that correctly. 40 into 70 is about 60. So there's a 60% drop on lumber liquidators. I pointed out this morning that there's a huge sale on lumber. This is not a complicated premise. Here's lumber down here. It's down 22% for the year. The price of lumber. What does lumber liquidators do? They sell lumber. What is their primary cost in business? Lumber. Lumber is down 22%. Lumber liquidators is selling lumber. This is good. They have a thing where they may have formaldehyde in some of the lumber they sold because they bought it from China and it wasn't up to spec and blah blah blah. But unless look at GM. All right, here's a good example. Look at GM. I'm gonna move this chat box. Hang on. All right. I will point out that GM here went from 37 to 28, all right? That's down 10, is about 30, 40%, right? They were killing people. They covered up the fact that they were killing people. They conspired to hide evidence that they were killing people and people died in their cars because they kept selling cars with faulty, whatever the hell they were, faulty airbags. I don't even remember what it was anymore. But they killed people. And you know what they're doing? They paid a fine, they fired a couple of people, and now they're back to where they were before everybody found out they were killing people. Lumber liquidators didn't kill anybody. They probably didn't even cover anything up. All they did was sell some wood that wasn't up to California code. And that's even in debate at the moment. This is probably one of the stupidest sell-offs I've ever seen. It really is. I mean, it's just an amazing concept to me that this thing is down this long and that people just can't figure it out. But you know why? Because they're not a very big company. It takes even a small thing is a big hit on their earnings. But they're not so small that it's going to put them out of business. It's just a ding, and they're going to get hit, and they'll recover. It's more like when BP went down. They stayed down for quite a while because it was a legitimately horrible thing that they did. BP destroyed an environment. They knocked out tourism on the entire Gulf Coast of the United States. They impacted the lives of millions of people. They ruined people's businesses. They ruined people's homes. and they recovered. But not lumber liquidators, oh my God, because they had more formaldehyde in their wood than the California maximum safety code says you should have. And not that anybody's actually been sick or injured by any of this, but they may have to go and rip up some floorboards and then put some new floorboards down that are up to code. It's stupid. Anyway, so I like lumber liquidators, and we'll get back to the trade. So the trade we took on lumber liquidators is now, well, we changed it since, but now we have 10 long, and it's still, again, it's taking off a little bit. Notice how the pricing, it's up $700, but it's still a great trade. We have 10 January 25 calls, all right? And then we sold 5 of the 55 calls. Because, well, at the time, they were priced ridiculously. That's why we're making so much money. The 55 calls have calmed down considerably. We had 10 25 calls. We sold 5 55 calls, and we sold 10 25 puts. Those are still priced ridiculously. They're, in fact, priced higher than we did. So even if you look at it this way, these 10 calls at 860 are almost completely offset by this. Well, now they're 810. So if you sell these calls for 810, and then you buy these calls for 810, sell these 25 puts for 720, your net there is only 90 cents. So to get a free ride, you only have to sell a 90-cent call on top of that. I would be less aggressive than 55. I think if I was going to sell again. Let's see. Well, let's take a look at lumber liquidators. And by the way, tell me if this stuff doesn't make sense to you. But I'm just trying to me, sometimes I say things I'm like, it was obvious to me, so it might not be obvious to you, but I think this is. So now, in fact, here you go. So it's currently showing like $9 for the 25 calls. And then you could sell, let's say you sold these guys, so 25, let's say you sold the 40s for, well, the last time it sold was $4. So let's say you sell these for $4, all right, or $3.50, it doesn't even matter though. So then you take 9 minus 4 is 5, and let's say so somewhere between 5 and $5.50 is your net there, right? Then you sell these $20 puts for $4. So now you're in this trade for $1.50, the 25-40 bull call spread. You're in a $15 bull call spread for a net of $1.50. And the worst thing that can happen to you is you'll end up owning lumber liquidators at $25. I'm sorry, at $21.50, net $21.50, because you only have $1.50 cash in the game, and you have it. So you're in for $1.50 of cash, and you're obligated to buy them if they go below 20. 20 is 20% below. 7. Yeah, wait, 30% below where we are now. 25, say. So 20 is 25% below where we are now. Oops, sorry about that. Shouldn't be ringing. Damn it. All right. Hang on, I'll take a second. So your worst case is getting into the stock with a 25% discount. Your best case, if you were going to make 10 times your money if Lumber Liquidators recovers to 40. And by the way, 40 is here. It's still a mile below their lows. And they've got 2 years to get there. And you will make 10 times back on your cash. That is a good trade. And again, since I can make long-term portfolio trades where we lay out $1,500 and we're going to get $15,000 back in 2 years, I don't have to make a lot of trades. And I shouldn't in an uncertain market. And let's talk about in 2008. We had the ability to do this with Lehman. We had the ability to do this with Bear Stearns, right? It would have been stupid if we made big trades on those because you know what? They both ended up going bankrupt. But we also had the opportunity to do it with Citibank and Goldman Sachs and Bank of America, and we did all those trades. We did Lehman and Bear Stearns too. We lost Lehman and Bear Stearns, but we made so much money on the other guys it didn't matter. But that's exactly what we did when things were collapsing in 2008. We went after the ones that were really beaten down. We took our bets. We made a bunch of small bets. We didn't make one big bet. We made a bunch of small bets that weren't going to kill us if they died, but gave us huge rewards if they went well. They all went well, except for a couple, except for like Lehman and Bear Stearns, Freddie Mac, AIG, Fannie Mae. They all recovered. Ford, GM, they all recovered. Okay, it was like shooting ducks in a barrel. I mean, everything recovered. IBM recovered. Apple recovered. Apple was $85. Wait, Apple was $85 divided by 7 because they've had a 7-time split since then. So on the new pricing, Apple was is $10? No, $11, whatever it is. So 12. Apple was $12 in 2008. $12 to the current price of $120. Apple's up 10 times since then. And that was also one of the top stocks that we kept grabbing at the time. I mean, I remember we got Intel, we got Microsoft. I mean, we just bought blue chip stocks. We didn't look for silly pharmaceuticals. We didn't go, nothing like some biotech company. We weren't going for crazy stuff. Although actually we did have some biotechs because they were some good ones back then that have all been bought out since then. That have all been basically bought out. There were some cool ones back then, which I can't remember now. It was easy though. We bought blue chip companies that were on sale. No, Lumber Liquidators is not a blue chip, but it's a perfectly good normal company that look at this. Beautiful, steady, nice growth, good chart, had a little hiccup, comes right back, goes up, comes back, a little down here, comes back. Nothing in the world is going wrong until this bad report. Then boom. Did anything in their business model change except this bad report? No. This is the only thing that went wrong, and it's a quantifiable problem that can be fixed. Just don't buy that wood anymore. Fixed. All done. Go to the people you did sell that wood to, which isn't everybody, by the way. It's only the people, technically it's only people in California, but even if you say it's everyone in the United States, they sell like 100 kinds of wood floors. It's only the people who picked the 5%, 10% of those wood floors that they sell that have them installed over a certain period of time from that manufacturer in China. That's the ones they're going to have to replace. That's if they go to the whole United States and voluntarily do it. Legally, they only have to do it in California because California is the only place with a crazy, ridiculous code like that on the environment. All right, so that's enough of that speech. If you don't buy the Lumber Liquidator, you're a fool. End of story. All right, next. Let's go back to the questions. NKD. Is the Nikkei falling due to the U.S. dollar? Well, yeah, that's definitely one of the reasons, but it's not the only reason. Nikkei is falling apart because it's unsustainable. They're trying to do this Oh, for God's sake. You know what's happening? It's ringing on a line that usually is not used. And that line doesn't, I didn't cut off that line. Sorry about that. Oh, wait, I guess I can cut off that line. There you go. Nope. Isn't that weird? All right. That's like a line we never use for anything. I'm not sure why it's ringing. All right. Where was I? Nikkei, right. So, you know, look, the Nikkei is just unsustainable because you got to look at the realistic situation that's going on in Japan. They're in incredible amounts of debt. They've attempted this crazy stimulus where they said their solution to being incredibly in debt was to pile on more debt, to double down on their debt in hopes that they will be able to boost the economy so much. And this is the problem. When you live next door to China, you think you can get your economy up to 7%, right? You look over at China, you're like, wow, they're growing at 7%. We should be able to grow at 7%. But you can't because you're an old country full of old people. Do you know in Japan, they sell more Depends than diapers? All right, think about that. More people use Depends than use diapers in Japan. That is a scary, scary statistic. They've got an aging population. They don't have enough young people to replace it. They are, they like us. They've lost a lot of their manufacturing base to China and other Asian countries where the people work much cheaper. Oh, for God's sake! Wow, this is so embarrassing. I have no idea how to stop this thing. Okay, so if it does again, I'll unplug the damn thing and figure it out. But so what are they going to say? Oh, yeah, Japan, right? So anyway, they're in deep, deep trouble. And they're not turning it around. And the other problem is because everybody uses China as a benchmark for saying, oh, we could grow our economy like this. China's not growing their economy at 7%. They're faking it. China has 53 airports that are empty. The airport's there, the runway's there, there's no planes, there's no passengers, there's no nothing, nobody works there. They have big empty buildings. They've got railway stations all over the country, empty. They've got thousands and thousands of miles of track that are empty. They've got cities that are empty. They have entire cities that are empty. They have shopping malls inside of cities that are empty. Because they just kept building stuff and they expected people to go to wherever they built it. It didn't work. That's there's the danger of planned economy. This is where capitalism does work compared to communism, which they're not really communists, but you know. You can't just expect to build things and just have it. You can't centrally plan the expansion of your economy. Economies have to expand naturally. You have to allow the patterns to emerge and encourage and discourage certain activities that people are doing, but you can't just authorize a province, which is what they do. They authorize a province to spend, $50 billion and build a city. And seriously, they put a city in the middle of the desert and then put a train track to that city, and they figure, okay, now everybody's going to go there. It doesn't work like that. It would be like, it depends where you live, of course, but it would be like where I'm in New York, and if you built Harrisburg, Pennsylvania today, and made it a beautiful modern city, and said, oh, it's only an hour, it's only an hour and a half, or it's only an hour by bullet train outside of New York, nobody's going to go there. Okay, it's not going to make people go to Harrisburg, Pennsylvania. It's just people don't do that. People don't, I'm sure, think about places where you live where they might do that. It's people don't just go wherever you build something. They don't change all their habits. They don't uproot their lives. You have to have all these little connections, all these little wires are connected to people. They like to shop a certain place. Their family's here. They like these places. They grew up here. They go to school here. It's hard to cut those cords and get people to move away and have a different life. And that's what China thought they were going to be able to do, and it's not working. And also then they're not following through by encouraging it, because if you really want to have an empty city filled up, what you have to do is you have to employ people in the empty city and hire people in the empty city and create great jobs in the empty city, so that at least the pioneering kind of people would say, okay, I'm going to go there and do stuff. You have to encourage a major manufacturer like Foxconn to put their headquarters in the empty city and give them a shitload of incentives and just say, hey, you're gonna operate for free for like 10 years as you build this city up, and the rewards, you have to have a long-term view. If you're going to be the government, you have to say, okay, I'm going to build this city. I'm going to have this major company employ millions of people and fill up the city with workers, and we're going to make sure they have all the rails and all the lines and all the trucking that they need to get all their merchandise out as fast as it goes out of the city that they're in now. So they're going to be happy, and so many young people can afford to move there and live. It'll become a great place in 5 or 10 years. Then you reap the benefits as a government for the next 20 years of this giant city with all this business going on. That's how you build an empty city. They didn't do that. All they did was build the city and then go wash their hands of it and say, why isn't it filling up? That's a terrible idea. And they're doing this. They did it all over China, but even worse is the airports, because it's just insane. And part of that is because it costs a Chinese person as much to get on a plane as it costs us. But a Chinese person makes 1/10 of what we do. So how often do you fly? Holy crap. There. Jeez. All right, so next. So Zhao says, how far high do you plan to hold CL? Oh, geez. I don't plan to hold it at all, really. I mean, I really would like to get out of it as fast as I can, but what's going on at the moment? Oh, yeah, there you go, 60, 55. So, no, I'm hoping to get out as soon as it dips back down. I mean, that's my plan, and right now I should be pretty damn happy that it came down where it is. So, I don't get out of something because some moron on TV is saying 65. There's always somebody trying to talk oil up. All right, and if you have, but frankly, if you have 3 short at 60.42, it's 60.57. If you just had a heart attack because it went to 61, you damn sure should be getting out. All right, you got to look at this thing and say, this is not smart. All right, because it didn't work, and it might not work, and it might continue to not work. Okay, because I'm sure as hell not going to ride it much further in this. If it starts going up again, I'm going to say the hell with it. I would like it to go down. I hope it goes down without giving me any more problems, but it gave me a hell of a lot of problems so far today, and I'm not happy about it. And I unfortunately ended up in a bigger position than I wanted to be, because I was trying to average it up. It went higher than I thought it would go. And if it can't break down below this red line, which is at 60.35, which is actually my break-even point is now 60.40. So I'll be out before it hits this red line, frankly. All right, so if we get to 60.40, that's where I'm getting the hell out. I don't want, I might leave a few on, but I mean, I don't want to be in 20 short. And so, depending on what your tolerance is, my usual amount short is 2 to 5. I'm happy being 2 to 5 short. I only ended up being 20 short because it went up 20 cents, and I bought another one. It went up 20 cents, I bought another one. It went up 20 cents, I bought another one. I kept buying them on the way up because I would rather have a lot of shorts than go down. Now, unfortunately, though, it went up so much that it went up so much without a pullback. It went up. Let's go to the active chart. Hang on. Where's my oil? Here. You see, it went up so much without ever pulling back that I never caught here. I almost had it here, and I didn't because I wasn't paying attention. I should have gotten out here. I would have been a happy, happy camper, but I unfortunately took my eye off the ball when that was happening. because that was 9:30, right when I'm finishing my post in the morning and publishing everything. Exactly right then, when I was not paying attention, is when it hit my break-even point and went back up. So it was incredibly bad that I didn't get out there. Had I gotten out there, I would have been happy to double down here, and now I'd be making a ton of money. Didn't work. All right, so I'm stuck in at 60.40, and I want to get out. That's all I want to do. Now, as you saw, I was down 7,500 before. Now I'm down 3,000, so that's much better, and I can easily make 3,000 bucks. So I'm not inclined to give this much of a chance to come back on me. I'm watching the dollar. I don't like that it was rejected here. And if the dollar goes lower and this goes higher, and I'm going to not be happy, so I'm going to want to get out. All right, but that goes back to what we were talking about earlier in chat. Don't expect things. Don't plan things. Don't expect things. You watch it and you react to what it does. Don't expect it to do anything. It's very rare that we have a plan where we say, I think this is going to go to this. I think it's going to go to here. I think it's going to go to here. I think we're going to see 57.50 again. But I'm going to bet freaking, I'm not going to bet that, because it could go the other way the same amount, and I could lose like 40, 50,000 bucks. So I'm not that sure. I'm not betting the house on it. All right, I'd like to, but it's just that's just it would be fun to win, but it would also be terrible to lose. So it's not worth it. Not seeing chart. Not sure what chart that was, Chrissy. Sorry. I mean, getting out of my 48 puts, not going long. Oh, no. Now, okay, guys, if you say something like that, you got to realize I can't find the thing you're looking at. Like when you talk about something, you really have to repeat what it is. Puts. Oh, China FXI puts. Okay, I see. We rolled our puts up to the 50s. That's what happened. So you must have missed that roll call. But it's the same concept. It's just I still think it's got some legs. If you're in June. If you're not in June, you should probably take the money and run. Would you still buy Taser, or do you think it'll pull back again? If it's a buy, what's the best entry now? Taser, that kind of got away, I think. No, I wouldn't buy. I would not buy. Much as I love Taser, I wouldn't buy it here. It's gone. You don't have a chance. It's out. It's broken up. It's not going to be a thing. It's unfortunate. You wait for it. Wait for something bad to happen. Wait for them to disappoint. How many stocks don't ever disappoint and never come down? When does this happen? Even Apple pulls back sometimes. So, you just got to put it on your list, and you got to say, okay, Taser got away. If it ever comes back to like 25-ish, I would love to get in again. But if it doesn't, then you don't buy it. Then you have to look for something else. Is Lumber Liquidator correlates to the housing market and Caterpillar? I would say probably it is over the long term, but right now it's in a completely different ball game. The housing didn't drop 60% last month. Lumber Liquidators did. Caterpillar didn't drop 60% last month. Lumber Liquidators did. Doesn't matter. Even if those guys are 20% overvalued, then Lumber Liquidators is still undervalued over the long term. All right, and Caterpillar, by the way, 85 is that buy point on Caterpillar, so it's still a good buy right down here. I don't think housing is going to come back gangbusters, but I think it's bottomed, and I think we're safe going forward. Zhao says on LL, what the hell is the Fed going to punish? What? Why the hell is the Fed going to punish them with some legal crap? Because, okay, first of all, they're not necessarily going to. They're trying to enforce a really old, stupid trade law as to the handling of goods that you bring into the country, the handling of live goods plants, essentially, that are coming into the country. It's a technicality, and nobody said they're going to do anything. What happens, it's all political shit. There's a guy who's got a short, who owns a congressman, who gets it. This is exactly how Carl Icahn makes all his money now. And he's not the only one. There's a billionaire who owns a congressman. He gets his congressman to call for an investigation, and they investigate. It doesn't matter whether or not the investigation comes out good or bad. It just scares the crap out of people. It doesn't matter if it has any merits. And not only that, though, but one thing you're sure of is when you start a congressional investigation and you force these guys to go and testify, the Congress gets to tell these guys, I don't care what your business is, I don't care what you're doing, you're going to drop everything, you're going to come to Washington, you're going to produce documents, and you're going to get 45 lawyers on the case right away on our time schedule, otherwise we're just going to fine you in absentia. That's the way that works. So no matter what happens, it's going to cost them millions in legal fees, and it's going to hurt their quarterly profit. Lumber Liquidators had to put aside $10 million last quarter, which is why they had bad earnings. They put aside $10 million for anticipated legal fees and possible fines. They had to put aside for the worst case scenario. And what they think the worst case scenario is $10 million. Probably won't be anything like that. Like, look at BP. BP put aside $20 billion. They've only used half of it or something like that. All right, by the time they put it aside, the money that they put aside in the bank, well, not in the bank with the regular interest, but let's assume they were making 5% on their money, it's already been like 8 years. Okay, so 8 years later, at 5%, they've got 40% of the money they generated back in interest on what they put away. So when they pay it, they've got a 40% discount already just by delay. You know, that's how these things work. It's a big, giant freaking game. And the big companies win and the smaller companies lose. And when you're a small enough company, you can get beaten up by these vultures who come in and screw with your company. On LL, we closed the short January 17 calls on 429. Would you recover now or wait for a pop? We closed the short January 17 calls, did we? I missed that? Is that what you're saying? What, the 55s? Okay, Jim, remind me in chat. I'll take a look. I did not know we did that. That's a sensible move because I think I might have said we should do it and wait for the pop. I could definitely see where I would have said that, but I don't know why I missed it on the thing. Oh yeah, okay. Because 429. See, we have this dip here because they had earnings, and that knocked the 55 down. And it is a good idea because what we do is we do that, and yeah, then we wait because there's really no use to them at that price, and it'll take. In other words, these are 280. It's going to take most of 2 years to work off that 280. So these are like dead calls. They're not really worth anything to us. And like I just said to whoever I was talking to before, I would rather sell the 40s now because I'm not looking for it to go back to 55. I'll be thrilled if it goes to 40. And I can collect a lot more money selling the 40s than the 55s. So that's the logic there. Yeah, it's just not worth it. It's just not worth it. AXP was 10 during the area. There was a ton of stuff that was cheap during the crisis. It was the greatest time in the world to buy stuff. I was having the best time. All right. What if it's Yellen calling? Yeah, right. It's probably was somebody like it. Could have been somebody very, very important calling. But I'm sorry, that was annoying. What's driving the dollar? Is it the euro basket combination of FX? What's driving the dollar down? I don't know. I mean, the euro's okay. Well, if you want to attribute one thing to it, I would say what it is the two things. The yuan is strengthening. The Chinese yuan has gotten stronger because they are actually they're not easing. What they're doing is they're actually pulling back the liquidity in the market. They're trying to stop people from speculating. That's technically like taking is pulling money out of circulation. So the yuan's been going up and strengthening. The other thing that's been going on is Draghi about 2 weeks ago said, what did he say? It was he said don't bet against the euro. That's what he said basically. He said people who bet against the euro are going to be in big trouble. That made no sense because he's giving away money and pumping money into the system. The Fed is tightening, and he's saying don't bet against the euro. So again, this is one of those things where it was just so down low that it bounced. See if we can show you that. FXE. So, you have to keep it in perspective. The euro went down from 137, this is a year ago, to 102. So it's down 35. Now, 35 into 137, get my handy dandy calculator out here. Whoop, not that, whatever that is. Get my handy dandy calculator. And we say 132 to 102 is 35, divided by 135 is 25%. Fantastic. Okay. So we have a 25% drop from 135 to 102. All right, and even if you call it 100, whatever, it's around 25%. So what's our bounce going to be? We have a 35-point drop. That means our bounces are going to be 7 points, right? And the number here is actually 103. So what's 7 points higher than 103? 110. What do we call that? That's a weak bounce. What would a strong bounce be? 117. What's at 117? The falling 50-day moving average. So all you have here is a 25% move down, a weak bounce, and it's probably not even going to make this. If it does make this, it would be too fast, and it's going to hit the resistance here at 117 and smack down. So no matter what happens, we're either going to have a weak bounce and a failure here, or a bit of a stronger bounce and a failure anyway, and then we're going to resume our downtrend. This is all that happened here is Draghi. Oh, not here. I'm sorry, it wasn't here. All that happened here is Draghi caused this bump, because right around here is where Draghi said, "Don't bet against the euro." As it was coming, it already did do the weak bounce, failed the weak bounce. And that's a 200-day, actually. It's hitting over there, not the 50. So it fell, weak bounce. And these guys know this. When they make these announcements, they know exactly what they're doing. They're screwing with the TA people. So weak bounce, fail, back to this line, would have possibly failed, except for Draghi talking it back up in the zone. This gets some technical people buying. Buys him more time to weaken his currency without repercussions, and meanwhile the fact of the matter is he's weakening the currency while our currency is not being weakened. Therefore, down goes the euro eventually. All right, so I only got time for a few more. So let's see. I think formaldehyde they closed down the FEMA trails after Katrina. Was it? That's interesting. Okay. I guess you mean formaldehyde that was in the wood? Did they build the trailers out of the wood, or what happened? I don't know exactly. I don't know what that story's about. Maybe we should do the Pence tray. Yeah, I don't even know who makes this. Probably Johnson Johnson. No, my idea. Thanks, Jim. If I could have left it off the hook, I would have figured that out. I don't have that kind of phone. It's actually one of those Polycom thingies. KFC and McDonald's, they will come back. You know, I gave McDonald's some thought. Let's not get into it. The KFC is yum. I gave McDonald's some thought. Here's the thing about McDonald's. You're like, what? Why can't McDonald's just make a better hamburger? The reason they can't make a better hamburger is because the people who make a better hamburger, I thought about this, and I looked, I paid some attention. Actually some hamburgers to figure this out. I took the kids to hamburgers like 3 times this weekend because I actually did do a little research on this concept. I was trying to figure out what it is about McDonald's that they screwed up. Because the new guys like Smash Burgers and people like that, they make a hamburger by taking fresh meat and making a hamburger. McDonald's cannot do that, and it's not that they can't figure out how to take chopped meat and make a little circle and put it on a grill. What they can't do is they can't do it because McDonald's makes all their money selling crappy frozen hamburgers to their franchisees. Their model is based on selling crap meat to their franchisers. That's where McDonald's makes most of their money. They don't make it selling the burgers at the franchise level. They don't make it providing good food to people. They make their money by having this closed system where they get you to buy a store and then you're forever forced to buy their food from their manufacturing plants. They can't start going fresh. It's not possible for them. It would be a drastic change to their model. That's why they're stuck in this model with their crappy food and bullshit prices. And everything they've tried since hasn't worked, and it'll never work because the core problem of McDonald's is that their food sucks. The basic food, the thing that gets people to go to McDonald's. Nobody's going to McDonald's for their salads. Nobody's going to McDonald's for anything really, but you go when you want a burger. And more people say when you want a burger, the definition of a burger is not McDonald's. So that's what the problem with McDonald's is, and it's not that fixable. Not unless they're going to have to take a big hit on their margins, because what they would have to do, and also the training and the change would be such a disaster. But they have to get their guys to buy their meat locally and make fresh burgers. Because people like the fries, people like the shakes, although the shakes are gross actually. But people like the fries, people like the shakes. They could sell all their stuff if they had that one signature dish that people came in for, but they don't. And that's killing them, and it's going to continue to kill them. And it's just, the guys like the Five Guys burgers and the Smash burgers and all these new competition, what's the one and Shake Shack, they're all using fresh meat. And they're using fresh buns. They got fresh buns. They got fresh meat. They all have the crappy frozen potatoes. So that's 6 to 1.5 dozen, another what you prefer. But that's a big difference. Shake Shack uses actual ice cream, not that fake that fake stuff that McDonald's uses. They're using actual like dairy ice cream to make their shakes with, and they have all these different flavors and things. Five Guys burgers is just basically, it's a freshness concept that they go for. It's hurting McDonald's a lot, and the customization at Burger King still works. The Wendy's thing still works. I don't know if theirs are fresh or not. I can go to Wendy's. I think they're probably frozen, but somehow they're better than McDonald's anyway. The taste. It's not fixable though. You can't fix a frozen hamburger to make it taste as good as a fresh hamburger. And also the quantity of McDonald's is that such as you can't really change your meat stock or whatever it is they have to do to fix it. And also remember that pink slime scandal with McDonald's? That was one of their flavorings. Yeah, they forced people to take that out. That actually degraded the satisfaction people had with the McDonald's hamburgers. It's a big problem. It really is huge, and they're not going to fix it quickly. So it's not my kind of thing. Let's see. Oh, shit, oil. I forgot all about that. Damn it. Ah, thank God. Oh, no. Stop. Shit. See, I'm not maximizing here. I'm freaking so happy to get out. It bounced. God damn, I had a profit there, too. I missed it. Come on, baby. Come on, Phil. Yes. Oh, I feel so much better. 240. Thank you. So while we were talking, we made, while we were talking, I was down $7,500 when we started, and now we're down $400. So $7,100 profit on that oil trade while we were doing this webinar. That's pretty freaking good. I am so much happier now. So now if it goes up, I'm happy to go back to 10. If it goes up to 60 again, I'm going to go back to 10. And I'll be at an average of, well, let's see, I'm at 60. Well, my 5 now are not really 60-80. They're really at 60-40. This thing gets screwed up when you do it. So my 60-40, and if we go back to 61 and I buy more, let's say at 60-90, then I'd average about 60-60. I'm very comfortable doing that for the long term. Look at that, an actual profit, 10 bucks. So happy. All right, so my trade didn't go well. I stuck with it. I did exactly what we talked about all the time. I laddered into it as it went up, and it finally got a little bit more real, and now the reward. All right, even though I make money now, I'm going to be so thrilled because it's better. So I'm happy about that. Thank you for saying oil, whoever did. Ciao. Thank you. That was very well timed. even though it's like from 5 questions ago. What's the fastest way to calculate option returns? Well, you buy the option, then you sell the option, and you see how much money you made, and you divide it by the amount you started with, and that's your return. All right? I don't know what to say otherwise. I'm not sure what you mean by that. Craig says, with the Nikkei falling like it did today, do you expect it to continue? Yeah, I expect people to wake up and say, oh, my God, Japan is a freaking disaster. That's what I expect to happen. I can't believe it hasn't happened yet. Thank you, Jal. Thank you to everybody who's been watching CL for me. I really appreciate it. So this is great, though. I love the fact that you guys get it. You understand what I'm doing. All right? That was exactly right. Time to get the hell out. And I don't care if I pick the optimum exit. Again, it's the, you guys have seen me make 10,000. You've seen me lose 10,000, whatever. It's not about picking the optimum exit. It's about saying I want to get back to a small, manageable amount that I'm happy to trade, which in this case is 5 right now, and I'm testing at this level. And frankly, if you go back over 60, 50, I don't mind at all losing some money and getting the hell out of this thing for the day. All right, so hopefully that breaks down. We're coming to 2:30, the NYMEX close. So who knows if that's going to hold or not? But if it does hold, that's pretty damn bullish looking, right? So we shouldn't stay in if that's holding. All right. So Chrissy says he means calculating your profit and loss. Well, that's exactly what I did tell him. If you want to calculate your profit and loss, you buy in at a certain price, you get out at a certain price, you divide the amount that you made or lost by the original price. That's calculating your profit and loss. It's not different for options than it is for anything else. Of course, you have to recognize when you're talking about the cash amount that you are calculating, or if you want to, you go and take your margins into account also if it uses up some of your margin. That's a matter of your account, though, because, and again, that goes back to if you look at our portfolios, you got to realize where we are. We have $765,000 in cash. We have over 100% of our portfolio is in cash. And that just means the net of these positions, because of the way we sell premium constantly in the long-term portfolio, the net of our positions is cash positive to us. We actually sold more premium than we put into the position. Now, what does that mean? That means we have $1.5 million worth of unused margin. So there is no margin cost for us to take these positions. When I take $40,000 worth of positions with some margin, that maybe $30,000, $40,000 in margin, that's not a margin cost because we have so much margin. It's just sitting around being wasted. So, if you have a small account, you've got to look very carefully at your margin costs and say, well, how much is this costing me of my margin? What opportunities am I losing in this margin trade? And it means you should trade differently than you do in a big account. That's why we have the butterfly portfolio, which uses no margin. I want to point that out. All right, so this one, the long-term portfolio strategies use no margin. Very, very, very little margin. This is a good amount of positions still that we have. We have like 20 positions using basically, I'm sorry, the margin will be up here. I'll show you. We're using 208,000 out of 1.5 million. This thing doesn't give you a margin at all. This thing, but out of 1.5 million in margin power, we're using 200,000. That's nothing. It's not even 15%. 15% would be a little bit over that. So it's just a little bit under 15% of our margin is being used on this thing. In the short-term portfolio, where we do use margin, we are not at the moment using any. We have 56,000 in margin out of with 200 and something. Well, we have 223, so we have about $450,000 worth of buying power, and we're using 50,000 of it. Now, if you don't have margin, the best portfolios are like the butterfly portfolio, and that started out as a $100,000 portfolio. We're using zero margin in the butterfly portfolio because everything's covered. Very simple concept. Oh, look at that. We're almost up to 50% in the butterfly. That's great. So everything is covered in the butterfly portfolio. And we've got, again, it's the same kind of strategy. It's similar to the long-term portfolio strategy, but, we generate a lot of cash. We sell more premium than we buy generally, and that's where we are on the butterfly portfolio. And then, obviously, the one that uses no margin at all is the $25,000 portfolio. That uses zero margin because we don't have any margin in a $25,000 portfolio. So zero. That's the butterfly is not intentionally zero because we assume you have margin in the butterfly portfolio. But in the $25,000 portfolio, we literally do not take trades that require margin. All right, so that's the difference between those portfolios. And so as far as calculating, we wouldn't take margin into account doing that. if you're limited in your margin, you're limited in your buying power, you have to really pick a trading strategy. Oh, that's not even a portfolio anymore. So if you're limited in your buying power, you have to pick a strategy that works for your margin requirements and your buying power. All right. I think we're about done for the day. I know we're done for the day because I got to go. Look at that. I could have held out and made a profit. All right, I'm all right. I'm very, very pleased. So we're going to hopefully get a little ride down. I'd like to see 60. That'll make me, what, I don't know, make about $2,500 or so if we can get to 60. So I'd be very happy if that's the outcome. But that's it for the day. Thanks, everybody, for coming. I appreciate it, and we will do it again next week. All right, take care, everybody. Thanks.